In this video, I'm going to show you guys a secret strategy that you can easily deploy to maximize your yields when yield farming on decentralized exchanges. So in this video, we're going to use my ETH/USDC pool as a case study. And I'm going to talk about everything that goes into it. If this is your first time on the channel, I'm going to talk about what yield farming is and why you should be doing it right now, and just give you all the details around the strategy and just how making this small tweak could really boost your yields long term. So before we get into the content, I do have to say none of this is financial advice, per usual. Always do your own research, but use this channel as a starting point. So without further ado, let's jump straight into the content, starting off with what is yield farming and the capacity that we're talking about in this video. It's simply taking your funds and finding a pair. So in this case, ETH/USDC, you can take your Ethereum and your USDC and you can stake it on a decentralized exchange such as Aerodrome, such as Uniswap, such as Camelot. There are many decentralized exchanges, and when you stake it on the exchange and you put it in a pool, anytime people go from ETH to USDC or USDC to ETH, you get paid. And the amount you get paid is based off of something called the volume to TVL ratio. You want to find pools with volume that is higher than the liquidity that's in them, because that means that the liquidity is getting used multiple times. For example, and we're going to look at this when we get into the pool, if you have a pool that has a TVL of 100 million, but the volume's only 50 million, you'll make way more in a pool where the TVL is 10 million, but the volume is 20 million, right? When you have a volume that's higher than the TVL, in the second case, 20 million volume, 10 million TVL, that TVL is getting used over and over again. All of it's getting used over and over again, and it's all generating fees, versus the other one where the TVL is higher than the volume. If you have a TVL of 100 million and volume of 50 million, only 50 million is being used. The other 50 million, depending on what range, et cetera, isn't being used as much. And if it's not being used, it isn't generating fees. All right, so let's jump into this. So for this ETH/USDC pool, you want to first start off with where is most of the liquidity going to be when all of the buying happens? Because you have ETH mainnet, you have Optimism, you have Polygon, you have Base, you have Solana, you have all these different layer ones and layer twos where you can get into an ETH/USDC pool. So how do you know which one to park your liquidity? The answer to that is, where's the liquidity going to flow? So if we come on over to DeFi Llama, you can see it's $114 billion in DeFi right now. If we click chains, we can see that while most of the volume is in Ethereum, if we look at the runner-ups, so we have Solana, which is mostly meme coins, $8 billion in TVL. Bitcoin, it's not a lot of trading volume happening on Bitcoin. DeFi on Bitcoin, I believe, is a fallacy. Binance Smart Chain, Tron, and then Base. So you guys know that I am a big advocate of Base. I made a video talking about the importance of liquidity and why I think Base is going to be the best place to yield farm going into this bull market. So I won't go into all those details. Definitely give that video a watch if you haven't. The link is in the description. But this is how you have to think about it. Base is Coinbase's layer 2 blockchain, right? And anytime we see an exchange launch a blockchain, it's always successful, whether if it's a token that they're launching or just the overall volume. And we saw that with Binance launching Binance Smart Chain. Coinbase launched Base, and Coinbase is a public company. They're the top centralized exchange in the United States for users to get onboarded into crypto. They have their Coinbase wallet, they have the Coinbase exchange, and they're part owners in Circle as well. But the most important thing is, all these centralized exchanges are bridges to DeFi. You saw Kraken launch their Ink chain, and we're going to see more exchanges launch chains. But the important thing is, since Coinbase is the top exchange, they launched their Base chain. They make it really easy to go back and forth to Base, easier than they make it to go to Ethereum or Solana or Arbitrum or Optimism or any other chain. Did you know that if you go back and forth from Base to the actual Coinbase exchange, they don't charge fees? So imagine if you want to withdraw some USDC to buy something, and let's say you want to buy ETH, right? And you want to send your USDC somewhere. You're going to send it where you don't have to pay fees. This is like sending something is like taking a bridge to go from the centralized exchange to whatever the L1 or L2 is. You're taking a bridge. And it's common sense to go to the bridge where you don't have to pay a toll, right? And that is what Base is allowing you to do. So with that in mind, I'm also expecting Ethereum to do a 3 to 5x this cycle. So a 300 to 500% return. Super easy, super low risk, right? Within the next year, I would say. It may not be this year, but within the next year. So given the liquidity growth of Base as a layer 2, I'm expecting most of that buying volume within DeFi to happen on the Base layer 2. Because what happens is, during the heights of the bull markets and the depths of the bear markets, the centralized exchanges go down because they can't handle the volume, but decentralized exchanges never go down. So I'm expecting a lot of ETH to get bought on layer 1s and layer 2s outside of centralized exchanges. And given everything that I just told you guys, it should be easy to connect the dots to think that most of that buying volume is going to happen on Base, and then also Ethereum mainnet, because it is Ethereum mainnet. But most of the applications are starting to be built on layer 2s because the fees are cheaper, right? So I think Base will be the top place where people are buying ETH. Whales may trust mainnet just because it's what they're used to, and they have a lot of funds locked there, and they don't want to risk bridging and everything like that. But retail and smart investors who aren't lazy, they're going to be buying Ethereum on the Base network if they're in DeFi. Remember, not on a centralized exchange. So I want to get ahead of that volume, and I talked in many videos talking about how providing liquidity is like selling shovels during the gold rush, right? When you're providing liquidity, you're providing a service, and that service is giving you the liquidity to trade back and forth with. So if I know people are going to buy a lot of ETH on Base, I want to take my ETH and take my USDC and provide liquidity on the correct decentralized exchange, which is what we're going to cover next, so that I can make the most amount of fees. And I want to get my shovel shop set up before the gold miners come in versus having to wait and chase, because by that time they have already bought their shovels or made their trades. So now let's talk about the pair, okay? So you guys know that I love providing liquidity with volatile pairs in bull markets, because a rising tide raises all ships, and altcoins and ETH will likely raise together. But I also like ETH USDC, and the reason why is because I like vol pairs, because most people buy and sell altcoins with Ethereum. Like if I'm buying Pendle, I'm going to use ETH to buy it because that's where the most of the liquidity is. Like ETH is the asset that most altcoins are paired with in DeFi for decentralized exchanges. So most people are either going to buy an altcoin with ETH or sell that altcoin back to ETH, okay? Now, having that said, I also like ETH USDC because when people go to buy ETH, they typically like to buy it with USDC, and when they sell their ETH, they typically like to either sell back to Bitcoin, but it's not going to be native Bitcoin because it's on ETH, and a lot of people don't trust that, so they're going to sell it back to USDC as well. This is not me guessing, this is what has been happening since the birth of DeFi. And I want to use this pool to grow my ETH bag solely, right? So I'm gonna I use the rewards from my other pool to grow my alt and ETH bag. So whatever pool I'm in, I'll take the rewards and buy half of an altcoin, half ETH, and then compound the rest back into the pool. But for my ETH USDC pools, I'm strictly just buying ETH, and then taking the other half, compounding it back into the pool so I can grow my principal, thereby increasing my yields. So now that I know I want to be in the ETH USDC pool, how do I know which decentralized exchange that I want to provide liquidity in? Because there are so many. On Base, how do I know which one? Well, I'm going to come over to our Yield Hunter tool, and this shows you all the top liquidity pools in all of DeFi and close to real time. You can search by both tokens, you can search by one token, you can search by minimum and maximum TVL, and it gives you all this data, the APR, the correlation score, the liquidity, the volume, the fees, the volume to TVL ratio. You can also search by protocol and chain. And guys, if you want to get access to this, and you want to get access to a great community with coaches and all of the toolings that you need, such as this one, all the educational resources that you need. We have a 14-hour yield farming course that literally covers everything you need to know in order to manage your portfolio like a professional institution. Not only that, we're launching our 49 Weeks to Freedom Challenge here at the end of July, where we're going to be helping people reach 100K in their portfolios through providing liquidity. So if that is interesting to you, you have two options. You can either click the link in the description, you can book a free strategy session, and you'll talk to me and we'll be able to see if our program is a good fit for you. If not, you can always join our free group where you get access to other cool things as well. I digress. So I go on here, I already typed in ETH USDC, and the market's kind of been stagnant right now. So if you look at all these pools, you have Arbitrum, Sonic, Base, Optimism, Base, Avalanche, right? All these yields are pretty small except for Camelot. I'm not providing liquidity on Camelot because I'd rather just stick to, Uniswap, Airdrome, Radium, Orca, etc. So you can see that this ETH USDC pool is printing 346% APR, almost 1% per day, right? And now, guys, here's the secret that I was telling you about in the beginning of the video and in the title. It's not clickbait. The secret is the volume to TVL ratio, but not in the way that you think, right? So if you look at this pool, you can see that the liquidity is only 28,000. Now, a lot of people wouldn't touch that because it's like, oh, 28,000 a pool, that must be sketch or something. But guys, it's on Uniswap, right? It's secured by the Uniswap contracts. You look at this, the liquidity is 28K, but the volume's $1.3 million. So this 28K, do 1.3 divided by 28,000. 1.3 million divided by 28,000. 28,000 goes into 1.3 million over 47 times. So if you can think about in one day, if this is the 1 day volume, your liquidity is getting used 47 times versus, let's scroll down here, versus a pool like this where the liquidity is 34,000, but the volume is 29K, right? So you have some of this. 4K of this wasn't even used in 1 day, right? And it depends on the ranges that was set and everything, but this liquidity is being used over and over and over again. It's just being washed through, and that's just more and more fees. And a lot of people, if you look over here at the fee tiers, a lot of people's like, oh, I want to go for the 1% fee tier because I'm getting you get a 1%, there's a 1% fee on each transaction. But once you go to average everything out, you still aren't making as much. You can see the APR is 54%, and that's factoring in this 1% fee tier, flat fixed fee. So a lot of people stay away from these super small fee tiers because they're like, oh, they're small and they want to get that fixed fee. But what really matters is the total APR and the volume to TVL ratio. No matter how small or how big the liquidity is, as long as the volume is much higher than the liquidity, you're good. Also assuming that it's on a legit decentralized exchange such as Uniswap, right? So if I had to give an analogy, this is kind of like Whole Foods versus Walmart, right? Whole Foods is more expensive and people are going to go there to buy higher quality stuff. But like I said, the price is more expensive. So, you might not get as many as one thing versus going to Walmart. All they care about is giving you the best price, right? They sell everything for cheaper. That's kind of like this pool is like a Walmart pool. The fee tier is super, super low. And the reason why this gets used up a lot is because Uniswap has something called smart order routing, where it's going to route your trade. Like if I'm trading ETH USDC, it's going to route my trade to where that trade gets executed for the cheapest price, right? So if it's a transaction for, you're selling $1 million in one transaction, a small amount will get routed through this pool, if anything, right? Because it's only 28K in liquidity. But if you have a bunch of small trades, 15K, 10K, 1K, 2K, 3K, it's going to get routed through here first before it gets routed to the other pools that have a lot of liquidity, such as this one, 1.3 million versus 28K. This one has 3.9 million, right? So this would be like a Whole Foods pool, 1% fee tier, and you have liquidity at 1.3 million, but the volume's 207,000. Now on any day this can change, but I like finding small fee tier pools. That's the secret. Small fee tier pools where the liquidity is really low, but the volume is really, really high. And you can look here. This has a volume to TVL ratio of 47.43% because this liquidity is getting used 47 times in a day, as is what this saying. And I put air quotes around that, right? Because 28 goes into 1.3 million over 47 times, 47.4 times. And if we go on Uniswap, it says that my APR is 138% right now, but I literally just hopped into this pool not long ago, and I made my range pretty small. So I'm sure that, once I'm in this for a while and the real numbers start to come in, I'm pretty sure it's going to be over the 300-something% that was showing on our Yield Hunter tool. Also, I'm going to show you another thing. If I go to create position and I go and hit ETH, first I want to hit base, right? Because we're doing this on base. So I want to be I'm going to go base on here. I'm going to go ETH on base. And then I want to go USDC on base. Now, here's something else to notice. One, I want to go V3 because the tracking tools aren't yet integrated with V4 liquidity pools, like such as Revert Finance. So then once I click this, it's going to automatically get you into this pool. It says best for most pairs. I don't know what they mean by best. Maybe best is like the highest TVL or whatever. But best in this case damn sure isn't the best amount of money you can make, right? So you have to physically know which one. You have all these different fee tiers. This 0.2 one is the one that I got in, right? So you have 0.01, 0.02, 0.03, 0.04, right? 0.05, 0.3, 1%. So you have to, if you don't know what the volume to TVL ratio is for these, you'll probably just pick the one that it says best. This is 0.3. So if we go here and we go look on base for ETHUSDC, the 0.3 fee tier, you're only getting 31.2% on Uniswap on base. That's not the best, right? That's not even the second best. This one's paying a little bit more, albeit it's only 2%. And then even this one, ETHUSDC, the 1% fee tier, 54%. So I don't know what Uniswap means by best, but you really want to know these things before you get into the pool so you don't just click anything or trust what the UI on Uniswap is telling you. And I don't think they have any malicious intent. They're probably just saying best in terms of like, okay, this is the best place for liquidity to be aggregated based off of the trades that's been happening, etc. I don't know. But if you want to maximize your money growing, you want to look at the volume to TVL ratio. So guys, that is the end of the video. If you, like I said, if you want to learn more and be a part of a group, I even tell them all the liquidity pools that I'm getting into. I post when I'm rebalancing. I post what my exact ranges are. I'm not going to reveal that in the video. So if you want to get access to that, like I said, click the link in the description, join our free group, or book a free call with me to see if our program's a good fit. But with that, if you got value from this video, like, comment, subscribe, share with a friend. But with that, I am going to watch the sunset. I am here in Cordoba, Spain. Thank you so much for watching. I love every single one of you who tuned in, and I will see you in the next video. Take care and trade safe.